notes there on their flexibility. One item to go. The most important one, well, one of the most important ones, cash value performance. What do they actually look like? Here's the thing. From an illustrated standpoint, they are number one and they have been for a long time. Now, the key word there is illustrated. When it comes to actual performance, I have NA here because it has been difficult for us to obtain historical performance, meaning policies that have actually lived the test of time, that were max funded, that have delivered internal rates of return of 4% or greater. We've had a hard time. Now, I will say that Penn has been great in working with us and trying to obtain that data, at least some contacts we've been working with. But the reason I do not put them personally on par with the four major mutuals, Mass, Guardian, New York Life, or Northwestern, is because we have been able to obtain data from them that they've consistently delivered policies or cash value internal rates of return of 4% or greater, a lot of times 5% or greater, depending on how far back you go. I have not seen it with them. So what I don't want to do is put myself in a position where we sell a policy solely based off the illustration and it looks great, but then it under-delivers significantly. So that's where the actual performance is not available. Now, we do have a policy on the books that was issued in 1990. I didn't write that. I was actually 2 years old at that time. This policy's not on me. Steve's age at that time. 2 years old. But 3.40% was the net internal rate of return, which is not that attractive considering the time period this policy lived through, and we've seen other policies produce stronger cash values. Now, again, a lot has changed since then as far as Penn Mutual's product pricing and such, but let's take a look at some examples here to look at their illustrated performance, but just properly setting expectations. That's my big thing when we look at any product, really with any company. So what we're pulling up here are two quick examples of Penn Mutual policies, and this will kind of tie everything together here for us. We've got a policy on a 40-year-old male, best health class in this example, one sample where I fund the policy for 5 years and stop at $100,000 per year, and then one where I fund it for 20 years and then stop. So on these examples, on the 5-year fund, these are both max funded policies, max funded, non-MEC. Penn's done a good job with their software in that respect. So option number 1, 5 years, nothing thereafter. Base premium, $14,000 and change. So it's 14% of my total annual payment. FPR premium, that's my flexible protection rider, just about $10K. So that $10,000 is not the cost of the term rider with Penn Mutual, not by any means. What that is again a combination of money going towards PUAs and the term rider. So my requirement in this particular example would be those two together, call it just about $24,000. I cannot do what I could do with a Mass or Guardian, for example, where I can commit to very close to that and add the rest in PUAs at my leisure. 100 in, cash value right off the bat, about 80%, 79% to be technical. So again, Penn out of the gates typically is not going to be as strong as most insurance carriers. You can take Mass, get them between 87 and 93%. Guardians typically 88% right off the bat. With Lafayette, with their PUA flexibility, you can get between 90 and 95% a lot of times. So if I'm interested in early cash value, I do have a disadvantage here. Now as time passes, doesn't matter a whole lot. Break-even point here between years 4 and 5. The guaranteed break-even point on this example was between years 8 and 10. Now the 20-year fund, here's what I want to touch on here. $26,000 relative to the 5-year, $14,000. Term rider, much higher as well. The death benefit's higher really to ensure we don't trigger a mech at any point in time as the years pass. But my point here is with Penn, I do have to have some insight when we construct the policy on how long the policyholder wants the ability to pay into the policy. So if you're in a situation where you say, hey, I want to put in 100K per year, but I might go 5 years, but hey, if I want to keep feeding this policy because I like the way it's performing, can I keep going? Can I start with this and then keep paying in 100K per year? The answer would be no. I'd run into a mech issue. I would be forced to pay a lower amount of money in with this particular policy. So what we've got to do is construct it to really build in the ability to add 100,000 per year for a longer period of time. And what happens there, because I needed a larger term rider and such, break-even point is extended. Now, where we talked about Penn illustrating the number one values, right, from an illustrative standpoint, they're dynamite. This will project the strongest cash values from a long-term performance standpoint in the industry, and they have for a long time. What's interesting is they have a 6.1% dividend rate. Mass has a 6.2% dividend rate. These guys, from a projection standpoint, crush Mass. But again, in reality, when I look at the actual performance, haven't seen it yet. That's, again, this is me personally, you're hearing here, what I like to look at with policies. So we've got these two columns, the average internal rate of return and then the annual internal rate of return. So over a 30-year span, here I paid in 500K, I've got about 2.1 million. Average IRR, just under 5.25, 5.2%. Annual, which represents what I'm earning year over year, 5.63%. Very similar over here, just about the same. And again, from a projection standpoint, if you are looking at different companies and shopping and comparing illustrations, these guys are going to show the greatest values over the long haul. But again, this is where, if you're working with us or anyone looking at actual data, for example, when I work with banks or corporations, we're looking at historical performance, who's produced the strongest cash values consistently, has among the strongest guarantees. We look at that kind of stuff. Because the big thing that I get nervous about with these kind of projections is if they show great numbers and then under-deliver, that's where a consumer is going to be unhappy. And typically they're going to be unhappy with the agent. So I'm not saying that this will not happen. We can use Penn. That's how we model these illustrations and such. And we can certainly set this up for you and anyone. My thing is just in always properly setting expectations, make sure we see everything up front, the flexibility features, historical performance, loan rates, direct recognition, on and on. But overall, I mean, Penn Mutual is not a bad company. If we want to give them a shot, or if you are very interested in them, you can certainly set them up. Just understanding the ins and outs, the PUA flexibility, the historical performance, the loan features with the direct recognition, that is important to be aware of. As always, I hope this helps. Reach out with any questions at all, and we'll talk to you soon. Thank you. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.